Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, Sanjiv, co-founder and president of Pagaya, and Justin Etkin, co-founder and COO of Tropic. We're here to discuss the shifts in spending for the consumer and enterprise. It's great to have everyone with us. Certainly a timely topic as we head into, believe it or not, the last few weeks of 2025. And Sanjiv, the story seems to be the decoupling of consumer sentiment and consumer behavior. What are some of the shifts that you've seen?
It's absolutely true. We see that consumer sentiment is obviously a little down, but consumer spending seems to be pretty strong. The biggest shift we have seen is the consumer being a little more discreet and increasingly shopping at places where there's value. So places like Walmart, Best Buy, Target, we find consumers over a higher demographics shifting in that direction as well. And in the lower FICO scores, we see consumers becoming much more discreet about the amount that they spend and the kinds of things that they spend on.
Yeah, and we'll get into how they are spending in just a moment, but let's contrast that for a moment here, Justin, with the enterprise story. And there's the silent budget killer. Tell us what that's about.
Yeah, I mean, for most companies these days, software tends to be a top 1 to 3 line item in their budgets behind headcount. And software's funny because it's incredibly hard to track. It's incredibly hard to budget appropriately, and so we see costs continue to balloon through uplifts and increased spend. And there's this little trend called AI going on right now that's creating even more kind of turbulence around how companies are thinking about spending, and so software is causing a lot of problems in these businesses.
Yeah. Michael, through the lens of an economist, how would you determine what you're seeing in the consumer data, retail spend trends, and so forth?
Yeah, I think it's similar to what you were saying, where there's a bit of a two-speed kind of consumer going on, where people on the high end, they're doing pretty well, right? They have a wealth effect supporting them with record home prices, record asset prices in the equity market. People on the lower end, though, they're less likely to own stocks, less likely to own their homes, so their main source of spending power is for wage growth. And if you've been looking at wage growth over the last few years, basically since the Fed started hiking rates, it's been coming down. And so they're not really getting the spending power from wage growth. And if you add on top of that inflation's been picking up a little bit this year, there's been an extra squeeze there. So it's people on the high end continuing to spend, people on the low end definitely struggling a bit more.
So if we know that the top 10% is continuing to spend, is consumer sentiment a fair way to look at sentiment, right? If we know they're going to continue to spend, and it's not showing us the whole picture, how they're spending, how they're shifting their spending, would you say it's an accurate picture?
Well, that's where you have to look the way that they disaggregate those headline sentiment numbers, because you can split it by income, you can split it by whether they own stocks or not, and so that really gives you a different picture. There's also been, in the last few years, a bit more of a politicalization of the sentiment data, where if you're a Democrat and there's a Republican in the White House, all of a sudden you feel bad, and vice versa. So you need to take the sentiment data with a little bit more of a grain of salt than you did before. There's also been a switch from phone-based surveys to online surveys, and apparently people feel much more willing to be dissatisfied on online surveys than they do on the phone with someone. So there's also sort of a break in the series in that sense when you're comparing where things are now versus where they've been historically. But yeah, you really need to look at the disaggregated data to get a better sense.
Yeah, and Chris, on the market intelligence desk, you are talking to Nasdaq issuers, Nasdaq listed companies, specifically within the consumer and retail space. Are you hearing similar sentiments?
It's winners and losers. It's kind of nice that we've seen some volatility come back into the market leading it right before Thanksgiving. But it also is a great sign for the markets themselves, because they found a nice area of support across the board. Consumer names did get hit, interestingly enough, and we're seeing a lot of the earnings reports starting to come out. Most of the S&P 500 had a great Q3 across the board. Revenue beats, 13.5% on growth. It was some really good numbers. Consumer names come out a little bit later for the most part. We did get numbers from Walmart, Target, and a few others. Walmart beat well. It's trading at all-time highs. We were discussing that before on camera. You're seeing the trade down effect, as you said, Sanjiv, before. But some of the smaller names are getting hurt a little bit. especially with ones without a physical presence and that aren't driving traffic to their online platform. So there's been a big disconnect there. We did have Dollar Tree out today, though, on the discount side, trading very well, up over 3%, beat and raise from this year, even though it's a lot of internal items that they did. It's still looking very good there. So what you're seeing is the areas where, to your point, Sanjiv, the lower FICA numbers would generally shop, the lower income brackets. You're seeing that trade down effect come down very much so.
Yeah.
You're seeing companies like Lulu down over 50% for the year. That's not working out well for them. But on the other side of it, you're seeing leisure spend. Restaurants are doing well, travel's doing well. If it wasn't for the government shutdown, we probably would have had different numbers for travel and a few other items as well. So there's a lot of good there. Again, winners and losers coming into the last couple of months, plus we got seasonality coming in, so it could be very good for stocks.
Yeah, and Sanjiv, buy now, pay later. We know that there's growth there. Is that a sign of stress, or do you think that's an adoption signal?
I think it's an adoption signal, and I think that it's basically the continuum between credit cards and cash. It's more sort of at the point of sale as opposed to a revolving piece of plastic, and I would generally discount the hype around impulse buying associated with buy now, pay later, and I would associate it more with people who are not interested in taking a credit card and not going through the hassle of applying for credit, but essentially getting it at the point of sale itself. For the most part, I find it fairly responsible, particularly loans that are 6 months, 12 months, 18 months, as opposed to the 3-month loans. So I always say that the loans that are being used to buy sandwiches are probably not as creditworthy as the loans that are being used to buy more deeper engagement products. And we find that generally speaking, it's performed quite well.
Because that can negatively impact your credit when you have shorter time frames within your lines.
I'm not sure, Jill, if credit is being reported right now.
Was it supposed to be reported to FICO starting this June?
I don't know if the
If it's
3-month is started and whether it's really sort of steeped into the underwriting process
Yeah.
just yet, because there isn't enough history.
Right.
But I will say that we have found that generally the smaller, extremely short-term transactional loans tend to not perform as well as the 6, 12, and 18. And I think it has to do with the level of engagement as opposed to sort of being overloaded, maxed out on your card, and now using this for 3 months to pay for something else. But yes, I do think that it's a sustainable trend, and I think it's here to stay.
Yeah, well, it's good to hear that it's more about adoption versus necessity. So that is encouraging. It's the first time I've heard that. So Justin, when we think about enterprise spend, is there any way that you can gauge an enterprise health, that kind of scenario based on how they're spending, what they're spending?
Yeah, I mean, what we typically see is software is one of these categories that is consistently growing. I think Gartner released a report that in 2026 they're expecting 15% growth in software beyond the double-digit growth that we've been seeing year after year. And the most diligent businesses are being thoughtful around what do we need to continue allowing ourselves to grow economically versus what are these bloated solutions that are costing us millions due to underutilized capabilities or kind of legacy systems that cost way more than a more modern or nimble solution they could go get today. So I think we're seeing a lot of the vigilant companies that are being aggressive around the replacement and upgrading of their systems, and they're tending to perform well on the cost side and the profitability side, versus laggards that are relying on antiquated solutions and systems that cost a lot more and therefore stifling growth across their businesses.
What about the pressure from AI? That little story that's creeped in since the end of 2022 and that pressure to show revenue and KPIs are starting to be called into question now.
It's a fascinating trend. So very common in software is this notion of an uplift. You'll see Salesforce as an example. Every year they have a 9% uplift on their subscriptions. This is common practice. But what we're seeing now is with AI, there's so much pressure to show revenue growth that's tied to AI that those 9% uplifts are increasing to 20, 25, 30% in some cases, where AI capabilities are being bundled into the same package or feature set that people were buying previously, and not really having the option to just add on some AI feature set that's going to cost more and drive more productivity, but rather being forced to incorporate that AI so that the sponsoring company can take credit for that revenue growth through a bundling mechanism, which is obviously has a little bit of skepticism associated with it.
Yeah, and Chris, that certainly has been a narrative, whether you're looking through earnings calls, conference transcripts, or just general conversation in the marketplace itself, where okay, we know what companies are driving the AI trend, but for those companies adopting it, what does that mean for the bottom line? How are you quantifying it? What are your KPIs? It's a big conversation.
So a lot of the problem that we were hearing, and which is some of it's very good, but some of it's also very negative, is the adoption model and how it's being used. That's always been the question. Most of the companies that you listen to on the earnings call, for whether it's restaurant, consumer, healthcare, even to that point, you're looking at how are they implementing, and a lot of times they're unsure of what the correct model is. We're going through some of that here internally as well. We're experimenting, seeing what works and what doesn't work. If what you're saying, Justin, about on the bundling part of it continues to be fruition, it is a significant waste of corporate dollars into the bottom line. And it's been pointed out on a couple of different calls. Plus, when on the big boys, on the tech side of it, you're talking to Mag 7 and everyone else involved in there, there's a lot of integrated financing that's going on in there as well. So some are borrowing and giving and borrowing, and there's a concern around that. So what the end game is uncertain. All I know is that people are asking a lot of questions, and even like an NVIDIA, who showed strong demand for their AI products, still got hurt in the market immediately following halfway through that session, that day closing down. So I think there's a lot of uncertainty from the investor standpoint of where it's going to go, not on the corporate side.
Yeah, I mean, there's a lot of companies are really in like test budget mode over the course of 2025. That's what we've seen. Investments on trying this AI solution and that AI solution and seeing what kind of impact it's going to have. And unsurprisingly, the ROI case hasn't been super strong, because it's kind of like we're going to test with the budget without the outcome in mind, rather than say we want to see X, Y, and Z efficiency gains, productivity improvements. So let's make sure that we're measuring it appropriately. And so now we're going to see in 2026, how do these test budgets actually flow through the system? Are they going to pull back? Is AI going to be a failure? There are plenty of companies that are seeing massive gains in productivity enhancements, but they're the ones that are deploying it effectively with clear ROI cases, measurement, and plans around how they're going to actually realize the value.
See, and there's a couple good points that you made there, because you can have 1,000 test cases, but you have to narrow it down to one or two. What's the problem we're trying to solve? We get it makes everything efficient, right? There's no surprise. Where are we extracting the value now? And I think those are the answers that are going to have to be answered in 2026.
Yeah, and the uncomfortable truth is that much of the result from the AI test cases is this an AI solution or is this a people solution? A lot of the efficiency gains are really thinking about how can we 10x the productivity of individual humans, but also change what does that mean for our future hiring plans. AI can scale more efficiently. It can make people superhumans in their day-to-day, but are companies willing to go that extra mile to actually make the transformational changes in their organizations to actually realize these benefits? Or is that going to be so culturally,
Frowned upon.
unfriendly
Right.
or unpopular that they're unwilling to make those moves?
Yeah, we'll get to that in just one second, but Michael, we've brought this up a number of times. Perhaps the employment data, it's not that companies are letting people go, and that's why you're seeing, it's slowing down, but they're not sure how to hire, or that case hasn't been made yet.
Yeah, I think that's definitely an issue out there. I don't think it's the main reason why the labor market is soft, but I was at a presentation this morning, and one of the questions I got was about entry-level hiring. And it's the question of, what are you going to do if AI can do the job of an entry-level worker, but I still need someone with 10 years of experience 10 years from now? So, how do you balance that? And so that's a question that companies really need to wrangle with and figure out, what do new entry-level jobs look like? What does new training for entry-level workers look like? And so that's definitely something that we've seen. And then in terms of survey data on what businesses are planning, they're talking the next 3-5 years. They do think that AI is going to impact headcount, but a lot of them are saying it's mostly going to be, we have hiring freezes or we adjust through attrition and not so much through layoffs. So I think that's at least welcome news for people. We have seen a really low layoff rate in general in the labor market right now. But yeah, it's going to be definitely still in that kind of exploration phase right now, and probably for a few more years.
Yeah, it almost seems as if there was an overshoot in a way, right? I don't think the human in the loop is ever going to be replaced.
Oh, no,
I mean, regardless
absolutely
of what
not.
industry you're in,
Yeah.
you still have compliance, regulation, figuring out
Yeah.
where the value is,
Yeah.
right?
Yeah, I mean, I'll give you a different perspective on it. We are an AI company. Pagaya is an AI company. It enables lenders to provide credit over a broader spectrum using AI. Having said that, when you're providing credit, you can't be all AI. You have to have the human factor, because it's not just about being able to approve a loan when it becomes an issue. It's when you reject a loan that becomes an issue. And if you can't explain why you rejected a loan, was it because of fair lending? Was it because of race, religion, whatever, right? You have to have explanatory power. The moment you need explanatory power, you've got to dumb down your AI a little bit to a very advanced machine learning, so to speak. But the most important thing, again, is, as you know, in credit, it's all about not the yes, but the no, right? Similarly, it's not about how many people you gave credit to, but it's also being able to look around the edges and see when the risk is coming to hit the system. And those decisions AI can't make. Only human beings can make it. So I call it the quanto-fundamental approach to credit, as opposed to the pure quantitative approach to credit. And that's why, I find that somewhat exciting, because really, if I may indulge myself for one more second, when people talked about regulation making Wall Street, and then non-banks, Wall Street suddenly became irrelevant to Main Street. And so AI is coming in and on the edges helping Wall Street to be more relevant to Main Street consumers that would have been rejected by them and would have gone to a payday lender, instead are now getting credit because of huge amounts of information and data that's enabling lenders like us to provide much better credit outcomes. And I find that fascinating.
Yeah. Any anecdotal evidence?
So one thing that we're seeing consistently is there are definitely functions and areas in enterprise spend where AI is a success. When you think about coding and engineering, or some sales functions and capabilities, there are massive benefits to the productivity increases that AI can drive. And those are somewhat proven at this point for many companies that are more tech forward and willing to invest. Everything else, there's still questions. How do you assess the efficiency gains of something that's more subjective, like project management or some sort of strategic project-related initiative that requires more thought, brain power thinking, rather than the executional improvements around the day-to-day for the individuals that are involved. So there's lots of AI solutions that are out there trying to solve all these problems, but I think that the engineering, coding, and the kind of sales acumens are certainly clear winners so far.
And I think that's a great point that the both of you are making, that AI doesn't have the ability yet, or if at all, where it's able to interpret dynamic situations, right? You can have an AI platform say, okay, here's your 6-month timeline for project XYZ. Things happen, people get sick, people leave. It can't determine those things just based on what it's been asked to do. And I think we're still some time away from that. And again, financial services as an example, we're a heavily regulated industry.
Yeah.
It's not going to go away. If anything, I think you'll probably see a little bit of tightening there, and you have to comply with it. They're not going to just let a random machine take over that.
Exactly.
Yeah, and I think that the point earlier around some of the labor market, client services is one of the areas that's been hit hardest, most aggressively early on, because these are scenarios where they are knowledge workers, but expensive knowledge workers, particularly at the entry level, where someone has to learn and train to be really, really valuable in their space. And if you're cutting out a lot of that training ground, what happens to the deeply thinking people that are required to supplement the AI skills and strengths for making more transactional decisions, and where are they going to be coming from? It's a big question that I know a lot of people that are graduating right now are grappling with, around where do I get my training?
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.